Welcome back to Inside the Wall. In this episode, we continue our deep dive into the recently announced acquisition of Warner Bros. Discovery, focusing our analysis on the potential target and its economics, asset profile, and integration risk. To evaluate Warner Bros. Discovery as an acquisition target, you first need a clean, standalone financial baseline. Global linear networks remain the economic engine, generating roughly a 38% EBITDA margin and funding the rest of the business. But revenues are declining as advertising and distribution fall. Streaming is now consistently EBITDA positive, though ARPU is down double digits as growth shifts international. Studios are profitable but volatile, with earnings swinging quarter to quarter based on hit releases. Together, this defines Warner Bros.' core trade-off: strong cash generation today, paired with structural pressure and uneven growth dynamics. Warner Bros. Discovery's cash flow tells a more demanding story. In the first 9 months of 2025, the company spent over $9 billion in cash on content, nearly identical to its amortization charge, showing that massive reinvestment is required just to stand still. That spend alone exceeded total adjusted EBITDA. As a result, $7.6 billion in EBITDA translated into only $1.5 billion of operating cash flow, weighed down by content payments, interest, and taxes. WBD also relies on receivables financing to manage liquidity. Layer in $34 billion of debt and over $21 billion in content commitments, and it's clear an acquirer inherits a highly capital-intensive, leveraged business. With the standalone financials established, the real question is strategic value. Warner Bros. Discovery owns a mix of premium growth assets and businesses in structural decline. On the high-value side, Warner Bros. Studios, HBO, and the DC franchise are globally recognized content engines. In the hands of a larger platform, this IP can drive scale, reduce churn, and generate long-term value. Max also stands out as a scalable streaming platform that could grow faster with lower costs inside a larger ecosystem. But not all assets are growing. Global linear networks are structurally challenged, with distribution and advertising revenues down year over year. These assets still generate strong cash flow, but they're best managed for harvest, not growth. Meanwhile, streaming and studios demand constant reinvestment. This mix, cash-generating legacy assets funding capital-intensive growth, defines both the opportunity and the integration risk of acquiring Warner Bros. Beyond valuation, integration risk is critical. Warner Bros. Discovery is a highly complex organization, with a massive global footprint and operations across dozens of countries. Complicating matters, the company is already in the middle of multi-year system integrations, including ERP implementations that are still unfinished. On top of that, Warner Bros. Is in ongoing strategic flux. Its prior restructuring only recently wrapped. It announced plans to separate into 2 public companies, and it's now reviewing a potential sale. For any acquirer, this means inheriting a business already in transformation, significantly raising execution risk, and the potential for management distraction during integration. Another big risk in acquiring Warner Bros. Discovery sits in its capital structure and cash flow profile. Any buyer would assume more than $33 billion of debt, making the combined company highly sensitive to interest rates and credit conditions. On top of that, Warner Bros. Has over $21 billion in long-term content commitments that can't be easily reduced. Operationally, cash flows are volatile due to the hit-driven nature of the film business, and the acquirer also inherits exposure to the structurally declining linear TV segment. These factors make Warner Bros. A viable target only for buyers with strong balance sheets and high risk tolerance. Advantaged acquirers include tech giants, telcos, and those with high credit ratings who can absorb or refinance the debt and scale content. Disadvantaged acquirers, like private equity and leveraged players, would struggle due to capital intensity and debt. In synthesis, the company is an attractive target for acquirers with strong balance sheets, low cost of capital, and existing global distribution platforms that can leverage premium content at scale, and a challenging target for acquirers with high existing leverage, a reliance on stable cash flows for debt service, or a lack of scale to realize meaningful synergies. Thank you for watching this analysis. Leave a comment on what you'd like to see next.